Welcome back to Project Pulse. In the previous lesson, we looked at the fully merchant cases, meaning no contracted revenue stream and therefore limited lender comfort. And you can see the impact on the dashboard. In those cases, we weren't able to raise debt beyond roughly 30% leverage because cash flows were simply too uncertain from a lender's perspective. So in this lesson, we add a protection feature that lenders value because it creates downside protection and increases cash flow certainty. A revenue put option or RPO. Conceptually, the RPO turns part of our revenue profile into something that behaves much more like contracted cash flow, which allows us to raise more debt and improve debt sizing terms, all else equal. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. Now let's jump to the information memorandum. We are still in monetization pillar 2, merchant and risk management, and specifically we are focusing on the right-hand column, the 1-hour merchant plus RPO case. The underlying merchant setup is the same as in a 1-hour pure merchant case. We still have merchant arbitrage and merchant auxiliary services, and we still assume that lenders apply a 20% merchant haircut for debt sizing. The key difference is that we are adding a 15-year revenue put option with a strike price of $9.25 per kilowatt month and an option premium of $1.25. So the RPO is essentially a risk transfer. We pay a premium and in return we get a floor protection that improves cash flow certainty. On top of that, we are asked to run a cash sweep starting in year 6 as debt sensitivity. This is very typical when the financing is structured as a 5-year mini-perm. In a mini-perm, lenders often assume there should be a refinancing or a takeout after year 5, but they also want to understand the no refi outcome. So the cash sweep sensitivity answers a clean lender question. If there is no refinancing and no bullet repayment after year 5, how quickly can excess cash flows repay the outstanding debt balance? Alright guys, now let's move back to the model checkpoint file from our previous lesson. And the first thing we will do is move to our inputs time independent sheet and understand the key differences we have in case 15 versus case 14 from our previous lesson. So in case 15, we still have a 1-hour battery with a 200 megawatt rating at the point of interconnection. And from a revenue standpoint, we still get compensated for merchant energy arbitrage and merchant auxiliary services with the exact same inputs as in case 14. So the underlying merchant structure is the exact same. The only difference is that we now in addition have a revenue put option active, which basically serves as a financial hedge or insurance product. And key inputs to point out here is the duration of the hedge, that is 15 years, a strike price of $9.25 per kilowatt month, a premium of $1.25, and last but not least, we also have only a hedge capacity of 100 megawatt. So we guarantee 200 megawatt at the point of interconnection, but the financial hedge is only for half of that capacity. That already leads us to a minimum RPO revenue per year of hedged capacity times strike price multiplied by 1,000 because this unit is per kilowatt and our hedge capacity is on a megawatt basis times months year leads us to a minimum guaranteed revenue per year of $11.1 million. For this revenue floor per year, we pay an annual option premium of $1.5 million. And that 1.5 million option premium will show up in our OPEX section as an expense. Let's scroll down. And here in our OPEX section, you can see that our RPO premium shows up again and is basically just picked up from our revenue inputs up here. So this is the yearly premium the SPV will have to pay for that insurance or hedge product. Let's scroll down further. All the other key inputs are essentially the same, but now let's move to the debt sizing. And here in our debt sizing case, case 15, you will notice that we now have a maximum leverage of 60% versus 40% in the fully merchant case without an RPO. And the debt sizing tenor is now 15 years, which aligns with our RPO tenor. So through the RPO, lenders are willing to give 20% more leverage and 5 years more debt sizing because the RPO lasts for 15 years. Then let's keep scrolling. And we still have a 20% debt sizing haircut for our merchant revenues, just like in the previous debt sizing case, which was case 12. Then let's execute the master macro, move to the dashboard, and notice that we now have a total debt quantum of 54%. And let's directly compare that with our debt sizing case without the RPO. Watch the levered equity IRR as well as debt level. So right now we have a levered equity IRR of 4.88% and debt of 54%. And once we move over to case 12, our levered equity IRR is actually better, but our debt quantum is lower. And why is our levered equity IRR better? That is because our RPO premium eats up so much of our cash flow here in the cash flow waterfall. Watch what happens to our cash flow waterfall, to the gray area, which reflects our total OPEX, when we switch over to case 15. You see immediately that for the first 15 years, there's quite an uplift, which reflects the option premium we will have to pay. We will also see this in our integrated financial statements when we scroll up to our cash flow statement. And here in row 54, we can see that from our total OPEX of $108 million over a period of 20 years, we paid $22.5 million alone for the option premium. So clearly, from a debt sizing case perspective, the levered equity IRR has not yet improved. But let's see what happens once we apply that same repayment profile to case 16, which is our equity base case, without assuming an additional merchant haircut. So let's move to the inputs time dependent sheet. Let's pick up the repayment profile for case 15. Copy this. Paste it here for case 16. Then let's move over to the inputs time independent sheet and activate case 16. Execute the master macro. And let's move over to the dashboard. You will see that we now have a levered equity IRR of 11.4%. Then let's compare this to the equity base case from our fully merchant structure without an RPO. That actually wasn't case 13. Let's double check this. This was our break-even analysis. That was case 14. So in case 14, we get a 10.09% levered equity IRR. So although in the debt sizing case, our levered equity IRR was better off without the RPO option, you can see that once we flip over to the equity base cases, which assumes no haircut in merchant arbitrage and auxiliary services revenues, we actually end up at a better equity IRR. Now, conceptually, let's emphasize one important aspect about the RPO, which is that the RPO is just an insurance product. And that means, as you can see here in the cash flow revenue sources, that the RPO barely generates any revenue. And that is because our revenue put option only pays out if our minimum revenue floor is breached. So let's move to a specific year, 2026 or 2027, where we can see that our actual revenue in accordance with an RPO index, so that is just a proxy of what we will actually generate in revenue. So a revenue put option will typically link to a relevant market index and not directly to the SPV cash flow. It really depends on the hedge product, but in this case, we are linked to an index, and the index will say that in this instance, we expect for a portion of 100 megawatt in that year, we would expect roughly 8.5 million of revenue, which would be a shortfall of roughly $2.6 million in comparison to our minimum revenue floor. And that is the reason why our RPO only pays out in some years where this minimum floor would be breached. So you can see that in total, we expect payouts of $10.6 million over a period of 15 years. And at the same time, as we saw in the cash flow statement, we pay an RPO premium of $22.5 million. And how is it possible that we improve our equity IRR although we pay more for the premium than we actually get as payouts? That is because our lenders are treating this floor as contracted CFETs. And our contracted CFETs we size on a 1.3 DSCR, which allows us to raise much more debt than in the other fully merchant case. So in the other fully merchant case, we actually only raised, let's make sure we select the right one. Yes. So in the other case, we actually only raised 31.6% in debt. And now we are raising 54.1% in debt. So equity investors will have to contribute less capital. And since the cost of debt is cheaper than our unlevered after-tax project IRR, we can use that leverage and basically utilize the leverage more efficiently once we include a RPO. All right, and the last case we want to cover is what happens if we assume a cash sweep from year 6. So we are back to a debt sensitivity case. And to do that, let's first move over to our inputs time dependent sheet. For the cash sweep case, we again copy and paste the hard codes from case 16 to 17. So we have the same debt repayment profile for all 3 cases. Then in case 17, you will see that our cash sweep right here in the debt section is turned on, and it starts 5 years after COD. Flip over to case 17, hit the master macro. Let's move over to the dashboard first to visually grasp what is happening. And here in the cash flow waterfall, in the purple area, you can see that we now use the surplus cash flow after year 5 to accelerate debt repayment. And we can see that visually in 2 different charts, or actually 3 different charts. So first we see our cash sweep right here that accelerates debt repayment. Then in our DSCR profile, we can see that after year 5, in year 6, our DSCR drops to 1.0. So every single dollar that is generated is used to repay debt, which means we cover exactly the debt service in that specific period. And then you can also see that in our cash on cash yield chart, we do not distribute any dividends from year 2031 onwards. So the equity investor would in that case only expect a dividend in the first 5 years. And if the mini-perm were then to mature and there wouldn't be a bullet repayment through a refinancing case, lenders would expect a full cash sweep, meaning that all cash flow that is generated would go directly toward debt repayment. And the key question we would want to answer, we will find in our scenario output sheet. And that is when our term loan will be repaid in column T. So in the debt base case or debt sizing case, lenders would expect to be fully repaid by the 31st of December 2040. And once they assume a full cash sweep, they would actually be repaid by the 31st of December 2036, meaning 4 years earlier than initially expected under the debt sizing case. Let's move over to the operations sheet. And when we scroll down here to our debt section, you will see that our cash sweep is reflected right here from row 591 onwards and would kick in 5 years after COD, accelerating the debt repayment and basically paying out all cash flow that will be available for additional debt service. And you will also notice that in our equity section, that cash sweep is reflected as well. So we subtract the additional cash sweep causing our net free cash flow to equity to be 0 during the cash sweep period, because we use all the cash flow available for an accelerated debt repayment, which means that equity investors, in case there's no refinancing and we assume it's a 5-year mini-perm, would not expect a distribution for 6 years after loan maturity. All right, let's move back to the dashboard. So the key takeaway from this lesson is the role of risk management instruments like RPOs in project finance. Essentially, the same physical asset can support very different capital structures depending on whether cash flows are purely merchant or partially protected. In the next and final lesson, we will move into monetization pillar 3 and look at a hybrid structure. We will combine a full tolling case with a merchant tail, which is one of the most realistic transition structures you will see in practice. Alright guys, this was it for this lesson, and I will see you in the next lesson. See you there.